Welcome to today's edition of Lusk Perspectives. My name is Richard Green. I'm director of the USC Lusk Center for Real Estate. It is my great pleasure to welcome David Brickman to Lusk Perspectives today. David is the CEO of Freddie Mac, the well-known and rather large secondary mortgage market company that buys lots of both single-family and multifamily mortgages, packages them, and sells them to investors. It's particularly delightful to invite David because he is a CEO who also, and I hope you don't mind me saying this, David, is a geek like me. The first time I became aware of David, he was working on the actuarial study of the FHA program back in the 1990s, wrote a terrific paper with one of my frequent co-authors, Patrick Hendershot, on the actuarial soundness of the business, and has since gone on to run the multifamily business at Freddie, and from there, the entire company. David Brickman, welcome. Thank you for being with us today.
Thank you, Richard. Real pleasure to be with you. Just wish I could be there in person. And Richard, great to see you, and thank you for inviting me. Delighted to be with you this afternoon. Want to talk today a little bit about the state of U.S. housing market, kind of where we were pre-COVID crisis, where we are today, the state of multifamily and how it's changed, and where the GSEs are. And if we just jump to page 3, just to cover some of the key themes. And Richard, you may have touched on some of this. I'm not here to offer any deep economic views that you all don't already know. And Richard, you know better than I do, right? The economy is in the midst of a deep contraction. The housing market is interesting in terms of how it's responded, and obviously that's what we'll talk about momentarily. As for the GSEs themselves, we're in an environment where we look very different than we did in the Great Recession. We are a source of strength as opposed to being potentially one of the causes of the crisis. I think that portends well for what our future might look like. So why don't we jump forward, go to page 5, talk about really the state of the housing market. And leading into the crisis, the housing market was very healthy. In most regards, in terms of fundamentals, things look pretty good. There was one way in which it didn't look very good that we're going to talk a little bit more in depth about, and that's in terms of affordability. Supply had not been keeping pace, and that was creating additional pressures in terms of affordability, a growing problem that unfortunately now is likely to be greater once we come out of this. But then, of course, COVID hit. We've seen sharp declines in terms of measures of housing performance, construction in particular. Interesting, house prices are holding up. But the big question is really, where is the government intervention going to go? Because that's largely what's keeping the housing market stable at this point. So I figure my intent here was to tell you a story, do it with the help of some pictures, not to dwell too much on them. But if you go to page 6, start with the notion, some of the health in the housing market leading up to the last recession, both obviously we had over leverage in the financial system. We had a number of other problems, but we also to some extent had oversupply of housing. Not the issue here. If anything, you look at where supply has been post-Great Financial Crisis, we have barely gotten back to what we view as a steady state level, and you're really just getting there in 19. If you go to the next page, one of my favorite slides show folks to really illustrate where we are now and have been in terms of housing supply and how that's driven a lot of the housing market dynamics recently is shown here. The green is total supply, and what you can see, obviously, kind of just like the other chart, we haven't really even got back to the regular level, the sort of steady state, the average historical level, to be precise. But more importantly, we look at historical supply. Of course, the population has been growing this entire time. And if we really normalize where housing is today in terms of new construction relative to the population, number of households, we are well below where we've been historically. That's what that blue line tells you. We were barely at 1% of total households. And if we just take it as a general rule of thumb, households grow 1% per year. In the last few years, it's probably been a little bit slower than that. But then also we need to replace units that are being removed from the stock, we really need to be at 1 to 1.5% per year in terms of new supply. So 1 to 1.5 new housing units per 100 households. We are barely at that level, and now we see things taking an abrupt change, as we'll see in a few slides. We'll go to the next page. Not surprisingly, if we have supply kind of running low, demand, as I'll show you momentarily, is running strong. It's really materialized in a significant burden in terms of households and the affordability of housing. And we see that in kind of the difference between kind of where real rents and real incomes are going to be, and the growing gap, if we go back to 2000, between the two of them. And this really understates, to a large extent, even the dimension of the problem, because even this degree of affordability in terms of rents, where we've seen rents go, is an average of the subsidized and assisted stock and the non-subsidized stocks. If you're fortunate enough to have been in a housing unit that's received some type of government support or assistance, tax credit property, you have not experienced quite as much growth, which means obviously the offset of that is the market rate, what we have come to call the naturally occurring affordable housing, privately owned market affordable housing. The gap has grown even more than this. And again, pre-crisis, we saw that. We just went to the next page and very briefly, not surprisingly, where we've seen the greatest stress and where we've seen the greatest loss of supply is in the fastest growing markets. That's where really supply has been least able to stay pace with where growth has occurred. So all of that kind of gives us a picture of where we were pre-crisis. I didn't do a slide on house prices, but house prices, while they were deaccelerating, continued to stay reasonably strong. In fact, we had been projecting them to stabilize, potentially even go up because of some of the same fundamentals, the limited supply. But then COVID hits, and we see a dramatic change in the trajectory of the housing market. Page 10 sort of illustrates this. And here, looking at the single-family housing market, we see this remarkable drop in home sales, in the for-sale inventory. In the list price, I will caution you while I'm putting it there to show that kind of deacceleration. You'll notice it's still positive, and in fact, I think that's going to have a slightly different story as we continue here. It's certainly kind of moving in a direction. So we see, much as the rest of the economy, we see the housing market, housing transactions, housing activity slowing down. And if you go to the next page, I think you see that in the construction activity even more dramatically. I mean, that sort of the inverse of what the unemployment slides tend to look like in terms of if you're looking at the unemployment rate, this I don't know what 5 sigma type event in terms of what the change was in terms of a single period. That's going to take some time to come back. And again, I point out, we were just beginning to get to an equilibrium level of housing supply being delivered. Now that's really a little more on the single family side. And when I mentioned house prices before, obviously, that's the own side. I want to talk for just a moment about the rental side. We go to the next page and how that's faring through this crisis. And I think we want to start by saying the degree to which the renter has been affected by this crisis is greater than what we'd expect owners have. We just look at renters have on average half the income that owners do. They are more significantly concentrated in the industries, as you can see, kind of construction, entertainment, retail, that are most affected by unemployment. And one of the questions is really going to be what's going to happen as we see this whole crisis unfold for some period of time to the renter population. And it hasn't really manifested itself yet, primarily because we've got this unprecedented level of government support that's really keeping things going. If we go to the next page, I think a really good illustration of how that is the level of unemployment benefits combined with the supplemental support and even the stimulus checks has made it so most households are maintaining, in some cases even increasing their income. Here, admittedly, just a chart showing Georgia, with one income level, it's 21,000. You can actually see it going up. Obviously, if you're closer to 40, 50,000, it'd be more stable. But the majority of households actually maintaining or coming within a reasonable band of their income levels pre-crisis. But you can see what happens starting in August just based on the existing rules. And the big question, we talk a lot about trying to forecast what's obviously in our $2+ trillion mortgage book, what's going to happen. The big question, well, what's going to happen not just in terms of the economy, but in terms of government policy and what type of support might be provided, and what's going to happen to the millions of households, I mean, like these folks who in Georgia and every other state might hit July and then have reduced level of benefits. And that's where I think there's almost a little bit of false confidence in some of the numbers we see in terms of both get to it, kind of delinquency rates, forbearance rates, even and then in the case of the rental market, kind of levels of people paying rent. But so far, the generally we're seeing continued health, but I think the shoe has yet to drop in terms of what's going on. I mentioned forbearance. Let me go to the next page for a moment.
David, can I just add?
I think is providing some healthy stability to the market through this has been some of the policies we, Fannie Mae, others have rolled out in terms of, this is page 14, thank you, in terms of our forbearance. And those who aren't familiar, forbearance, it isn't forgiveness, it is suspending payments for a period of time, suspending principal and interest payments for a household. As you know, the CARES Act, or perhaps know, the CARES Act provided for forbearance for single-family owners for up to 1 year. A number of households, many millions of households, have opted to take forbearance. It does need to be repaid, and a big question ultimately is going to be how households ultimately choose to repay. We're just now coming to the beginning of the end of the first forbearance that was rolled out. First forbearance plans largely rolled out in March, really more April. So come July, we'll see how some of those get resolved. The good news here is primarily that we see the forbearance plateauing in terms of the take-up rates. You see that the Fannie Freddie number is in green. The FHA number much higher. That is tends to be a lower income population, and not surprisingly, and also higher leverage. So higher forbearance take-ups rates. In fact, in the last couple weeks, an interesting phenomena has been we have actually seen the forbearance rates go down. We've actually seen households withdraw their forbearance. As well as another interesting thing we see in the forbearance policies, we have a large number of households continuing to make mortgage payments despite having received forbearance. Clearly, a number of households sort of taking the option, not knowing entirely what their household fortunes might hold, and taking it just as a precaution. The question here, much kind of tying it back to that earlier slide in terms of government intervention, is what's going to happen when some of the support wears off. That's on the single-family side, much bigger population to a forbearance. We also are seeing significant multifamily forbearance. Multifamily forbearance is handled a little differently. In the single-family world, it is primarily just someone needs to request forbearance. There is not a screening process. There is no requirement that a borrower approve it. In multifamily, we do have more requirements in terms of demonstrating need. And certainly I will note also Freddie Mac has granted significantly more forbearance, say, than Fannie Mae. I believe they have more stricter standards. There are some measures they put in place if you request forbearance. Here we see it's only about 2.1% as opposed to the 6.5% in single family. I would note if we did it by unit or by loan, it's actually a bigger percentage. So actually smaller units, more affordable units, probably more likely to be taking forbearance. And certainly in our observation, where we're seeing most of the forbearance requests in our multifamily portfolio have been on what we characterize as our smaller balance portfolio. Properties that have 50 or fewer units tends to have less institutional ownership, and where there's kind of thinner operating margins, and also probably a lower income tenancy that is probably more, again, impacted by some of the things we've seen. But if we go to the next page, I still point out that the surprising thing, and it's good news, just hope it holds out, is that the data collected by National Multifamily Housing Council, I believe, in their rent tracker of over 11 million units shows that we really haven't seen a significant dip in terms of the levels of collections. When you think about the magnitude of unemployment that we have, the slack in the economy, to only see these collections go down effectively 3 percentage points since a year ago is, I think, pretty heartening. But again, we don't know how this is all going to play out. Let's go. If you go to the next page, I kind of hinted at this before. Interesting thing. So COVID hits, we see a significant drop off in terms of construction activity. Interestingly, most pronounced in multifamily. You see that 59% drop in terms of the annualized housing starts, less in single family. As a contrast to that, very interesting in terms of purchase activity in the single family market, is what we've seen is that applications for purchases have actually moved up recently. And that actually relative to the average we saw in 2017 to 19, we're actually now running above that pace. So the effect of lower interest rates, I think also the effect of some of the technology that we rolled out that others have provided on the front end of the business. I mean, a lot of the firms, online platforms, people like Zillow and others who are really making it possible to do more in terms of buying a house, looking at homes, doing things more virtually, I think has brought some life back to the purchase side. Again, we see that in terms of our overall applications, which I think bodes well for where house prices will likely remain through this crisis, with a big caveat as to we don't know how bad it gets. If we get something, I don't suspect a V, but if we do get something that continues to look like continuous recovery, if we don't see distressed selling, and I think forbearance really does provide us that, as far as provides that bridge to hopefully some degree of recovery, then I think the housing market will really experience relatively modest reductions in terms of our overall prices. We ourselves are putting it at 2% down for the rest of the year. I know some other firms are in a similar neighborhood, some even thinking we may not even go negative, but we see a resumption of growth next year. Again, with a big caveat, don't know what if there's another wave of the virus, if we have diminished government support, if any number of things go sideways, if diminished confidence and just simply the impediments to getting back to normal are significant. Maybe it's worse, but right now we're feeling very cautiously optimistic. This will be nothing like the last crisis in terms of where house prices go. A big part of that being the healthy supply-demand balance, or I should say unhealthy, only in that there was not sufficient supply as opposed to the last time around, and the modest leverage levels. I didn't put a chart in here to show leverage, but we're dealing with significantly lower leverage, not just in housing, but in the economy, relative to the great financial crisis. And so not likely to see that sort of vicious cycle of distressed sales pushing down prices, but getting kind of more stress in the housing market. So why don't we move forward? Let's talk a little bit about multifamily, and even go to the next page. Just observations. Multifamily has been on a tear since 2008. I and others have really called it sort of a golden age for multifamily. I think there was a lot of things, there's a confluence of a lot of factors that fueled that. It wasn't simply just the reaction, the aftermath of the crisis, and sort of households just being turned off home ownership. I think that's actually the most minor of the effects. Certainly credit and limited credit availability played a role there for a while. But I actually think the bigger driver, it is economic, but it's actually affordability is what's driven more of the growth. Affordability, a choice of Location, to some degree, a movement towards urbanization. We have to ask, is that going to continue? Is that going to change? As well as continuing demographic changes, a continuous gradual shift upwards in terms of the age at which households are forming families, getting married, having children. I think all of that has contributed to this broad growth in terms of multifamily being correlated but not quite synonymous with rental housing. I may tend to use them interchangeably. They are different only in that we can, of course, have some multifamily that's not rental and some rental that's not multifamily. In fact, a big part of the rental story is the single-family rental market that I don't know if I'll have time to talk about, but I think it's a very interesting kind of evolution, the growth of that space, particularly in terms of the institutional single-family rental market. But let me show you a few slides on multifamily to help make the case. If we go to, thank you, the really significant growth. This is the debt market, of course, something near and dear to our heart. And you can see sort of from the peak in 2007, in terms of annual originations of multifamily mortgages, about 150 billion, now 374 billion. I would have said, but for the COVID crisis, we would have passed 400 billion in 2020. Pretty confident we would have had a pace to have done that. And broad expansion of all different investor types. And to the extent that it's not as clear how dramatic this is, if we go to the next page, a little contrast in terms of debt growth here in the multifamily space relative to the single family space. This is mortgage debt outstanding. And what you can see in single family, the light blue bar in the middle, it's indexed, barely moving. We are just now roughly back to the 11.2 trillion. That's around where we were back in 2007. It hasn't moved much. The scale on the graph kind of distorts it a little bit. It did go down, I think a little more than sort of meets the eye. Again, back to where it was before. The green line, as you can see, moving pretty significantly up. So this growth of multifamily, a bigger part of the housing landscape since the last crisis. And of course, that's mortgage debt. Mortgage debt is largely tracking with the total level of capital stock, which is both, if we think of the total capital stock of multifamily, which we now think is over $4 trillion, both a combination of the number of units, and we saw the supply a little earlier, and the value per unit. And I haven't shown that, but significant value appreciation in terms of the multifamily space. And of course, all of that, we go to the next page, simply driven by demand, is that we have had, I do have supply here. On the supply side first, so I've seen this before, much of the growth in supply that got us back to the steady state level before was multifamily supply increasing relative to single family. So if you even go back to the earlier conversation and comments I made earlier about just barely getting to steady state supply of a little over 1 million units per year, it was really multifamily contributing more than its historically proportionate share to that level of supply growth. Now if we go to the next page, see demand, this being fueled by growth in renter households, slowed recently, but certainly, again, if you look at those green bars from the 2008 period forward, faster growth in terms of renter households than owned households. The home ownership rate kind of bobbing between 64 and 65. We actually updated this for the most recent data, probably closer to 65. But so not back to the 69%. It's obviously an open question. I personally don't think we're going to be getting much beyond the 65%. So we've got that shift in terms of the home ownership, the composition, rental versus owner in the housing market. And I want to go back to something I mentioned before. I think part of that is just demographics. We talk a lot about preferences, and I have a chart on preferences. But indeed, if you just simplify the whole thing and say, well, if the average household would have rented till they were 30, and then owned from 30 to 75, and then perhaps gone into, say, seniors housing, or it's gone to 80, and then maybe not even got into seniors housing. If now, instead of going to home ownership at 30, they're going at 35. And if at 75 now, some percentage are going into seniors housing, just break up the population for those two shifts, and that largely explains what we see here. But there is some change beyond just the demographics if we go to the next page. And I mentioned affordability and the economics of affording housing before. There's no question, if you ask American households, do you aspire to own a home? You will get an overwhelming yes. That still remains the American dream. That's what households aspire to. The question is, can they afford to buy the house they want? And that's been what's really changed, is with the affordability I showed earlier, with the growth adjusted for incomes or inflation of rents and house prices, it's just become less affordable. So the average household, for what they want to occupy, where they want to occupy it, if they want to be a little closer in, simply can't afford as easily the housing that they want in the owned market. And we can think of that in terms of saving up for a down payment. We can think about that in terms of monthly payments. But clearly the perception amongst renters is renting is the more affordable option. Now, interesting, obviously, if you ask owners which is more affordable, you tend to get a different answer. But what you have to recognize is they perhaps bought their house 3 years ago, 5 years ago, 8 years ago. What's really relevant is the decision today, not for those who've already kind of purchased their home. So what this increased affordability of rental shouldn't blur, though, is while renting is more affordable to owning for the average household. If we go to the next page, renting is itself becoming less and less affordable. And I alluded to this before. We've seen this gradual reduction in the availability of affordable stock. And while there's been significant growth in the stock, it doesn't quite come across as significant here just in the 2012 to 17 period. If we went a little longer period, 2010 to 20, it should show a little bit more dramatic. But what you can see on the far left, that's it's called discretionary here. Think of that as A-class real estate. That's a higher end. If you go to the right, that's workforce housing. You can see effectively as characterized. This is a qualitative construction in terms of the category of the housing of the rental units. What you've actually seen is we've got a zero, effectively flat growth in that segment. All the growth has really been in the top end, in what's being characterized as the high mid-range and this discretionary, perhaps some might call luxury part of the market. So we've had this significant pivot towards multifamily. Multifamily's benefited from that growth. The effect of that has been some diminished affordability. And the question is kind of where do we go from here? And I will only offer the view, I think it continues, is that the affordability pressures will continue to grow given what we saw earlier in terms of supply. The reduced supply of single family and multifamily combined with what appears to be continued strong demand is likely to continue to fuel house prices, again, if not this year, next year and beyond. So the affordability pressures will continue. Stock will not necessarily keep pace. That additional pressure will put additional burden, additional demand into multifamily, which in turn will put additional pressure in terms of the affordable stock. So let me shift gears. I think go to the next page and do just a little bit of shameless self-promotion about Freddie Mac and our role in multifamily. While I don't think we per se contributed to the growth in multifamily, I think we've certainly been a catalyst to some of the growth. And part of that is because we have a unique business model that really does represent, we think, the future of what the GSE involvement in the market. Those of you who are GSE, government-sponsored enterprise, Freddie Mac and Fannie Mae, our charter, our mission requires us to provide liquidity, stability, and affordability to the housing market, which we think we do every day. But what we really view ourselves as trying to do is to be able to provide liquidity without taking significant credit risk. We learned that lesson in the crisis, although I should note the multifamily business never lost any money, never had a quarter in which we had an operating loss. But we still think the best business model is where we distribute the risk that we take on. So that we're not really distorting the market in the same way. and indeed providing significant opportunities for private capital to invest. And we do that through our K-deal structure, which I won't walk through, which effectively lets us provide liquidity to the senior-most bonds that we create out of a securitization so that they can trade like treasury bonds, not quite as well as they do, but so that large banks, sovereigns, other global institutional investors can really treat them in terms of being a liquid asset, while the bottom of the capital structure, the mezzanine bonds, subordinate bonds, represent concentrated multifamily credit risk, which is a very attractive investment for those who otherwise invest in multifamily. And indeed, one of the benefits of the business model has been the involvement of multifamily operators, investors, participants in that market in this part of the capital structure. So let me wrap it up on page 28 and hope I haven't gone kind of too long. Let's talk about the state of the GSEs. You may have read some things. Where are we today? So as I started off by saying, I'm very proud of the fact that through this crisis, we've really been a source of stability and liquidity in the housing market. We have not been the cause of any crisis, and indeed, the fact that we are providing constant liquidity, even using our technology, our ability to use automated valuation technology, automated technology to confirm income, employment verification, even allowing us to close mortgages with really sort of no touch, virtual closings, I think has really enabled the market to continue without experiencing a significant disruption this time through. We're also able to provide the support through our forbearance programs that I think we can't change the ultimate trajectory of the economy, but what we can do is, to the extent that we're going to see a V-ish shape, we can provide that bridge so that we don't have the sort of the dominoes of stressed sales, distressed sales, creating a greater price pressure. And then in multifamily, what I'm only disappointed is we can't provide direct support to renters. It's one of the missing gaps. Our ability to provide forbearance in single family is a direct benefit to a household. They are able to conserve their income for some period of time if they're experiencing some degree of hardship. And this all feels consistent with kind of what we broadly want to have in fiscal policy. Multifamily, we only touch the owner. We do not have a relationship with the renter, and so it's not as direct a mechanism. Instead, we can have an eviction moratorium that is, I think, just slightly less effective. And I personally think we really do need more direct support for renters through this crisis, particularly if we see continued stress, as I alluded to before. And then part of the underlying story is we have very little capital. We have very little capital because we've been dividending it to the U.S. Treasury for the last 12 years. We have $9.5 billion of net worth of capital today. It is technically the Treasury's money. But interestingly, even in the last quarter, we put up significant reserves. We did not take a loss in terms of our comprehensive income. And that just such a night and day from what it was like in the crisis. And a big part of that is our having undertaken these credit risk transfers. The fact that we don't hold all the risk that we take on. Rather, we use a variety of structures to sell risk into the capital markets so that we are not some just monoline, highly concentrated holder of mortgage credit risk, but now able to better distribute that systemic risk around the economy. And that's why with only $9.5 billion, we continue to believe we will not be at risk of failure this time around. I mean, anything can happen. It could get a lot worse. But based on what we see in front of us, again, we're looking like we're going to hold strong. So last page on page 29. So we think we're providing tremendous value to the market. We're able to help owners, again, not as directly, but renters as well, continue providing liquidity to the market. There's now a new conversation taking place in Washington, and that is about what's next for the GSEs. As many of you probably know, we have been in conservatorship since 2008. That means we have effectively been under government control. We have been profitable for the last several years, again, even in the last quarter. And there's a lot of talk in Washington about potentially having us exit conservatorship, returning us to private status, raising capital, and we are in the process. Director Calabria has announced his intention to do that, the prospect of an exit in 2021 or 2022. We just have a new capital rule, a proposed rule out of the FHFA that we would capitalize against that is now receiving comments. We're in the process of retaining financial advisors, and it'll be very interesting how this process evolves. This ultimately, as it stands now, would not be a legislative process. Congress can ultimately get involved if they choose to, but what's really been penciled out is really more of an administrative process, whereby the Treasury and the FHFA chart a new course forward for us, which would be within the existing construct of what Fannie Mae and Freddie Mac are. Let me end there. My sincere apologies for the technological issues at the beginning. Really, I regret that and appreciate your patience with me. And Richard, happy to take any questions if anybody has any.
Let me, and David, thank you very much. And by the way, when I introduced you, I forgot to mention the most important thing about you, which is you have a daughter who is a student here at USC.
Thank you for getting that in, yes.
And of course, our favorite people on earth are tuition-paying parents. So thank you very much for that, David. So I'm going to turn to the audience for questions in a second. And again, if you have questions, feel free to type them into the Q&A box. But I do want to follow up on a couple of things that you mentioned. Early on, you were talking about the cliff that's going to happen after July in terms of people's income if they're unemployed. And that's something I think concerns all of us. But I'm wondering if there's a little bit of good news in the following sense, that what we're also seeing is the savings rate in this country has jumped to like 30%. And I imagine that those folks in Georgia who are making, I'm trying to remember the numbers on your chart now, say $1,700, $1,800 a month, we're now making $3,000 a month. They're not changing their spending a lot because they can, people aren't great sometimes at looking out years, but they're pretty good at looking out months. And so, they actually may have some savings that they can use to push this a little forward. I mean, have you guys thought about that at all? Is there any evidence that that's true, or is the savings coming from a completely different set of people?
Well, I don't know if we have any proprietary data on it, but we have seen the same thing. I know we have seen the savings rate, at least our economics team is telling me. So we have been looking at that and wondering what that effect will be. Now, I go a little to the negative side of that. If that's going to really reduce consumer spending and make it more difficult for the economy to get going and puts pressure on jobs, that's the downside of that. So I agree with you that so savings should be a positive, at least in terms of certainly households being able to withstand a little bit more stress, even if you go back to my comments about being able to invest in housing. So probably actually net good in terms of house prices. But I do worry about if we stay at this level of savings, do we have a much prolonged recovery, because we just don't see the return of retail and hospitality and some other sector. How much does the automobile industry suffer because nobody buys a car for a couple of years because they're saving too much? And does that, what are the knock-on effects of that? So.
I'm going to ask a somewhat geeky question before I turn it over to the audience, but on your last slide, I can't help but ask, the capital rules that have been proposed basically say Fannie and Freddie have to raise somewhere in the neighborhood of $250 billion of capital to be released. And so presumably you would go do an IPO or issue more stock, or I don't even pretend to know how the current preferred shareholders would be treated under these scenarios. But that seems like a really heavy lift to me to get out of conservatorship by when Director Calabria expects you to get out. Am I doing my math wrong, or?
No, you're not. It's absolutely a very heavy lift. So let me just acknowledge that. And it would be, as currently penciled out, it would be $100 billion for Freddie Mac. It would take several years. It would likely take several different types of capital raises. So you're asking IP, not sure what type. And my answer is all of the above.
Okay.
And preferred and common and subordinated debt and probably a whole hodgepodge of different instruments, and as well as us retaining earnings, which is just a little bit of good news. I mean, if we go back to last year, I mean, we have the capacity to earn approximately $8 billion per year. Not the scenario we like best, but if we did nothing but just retain our earnings for 12 years and actually given growth, we probably, more like 10 years, then we would achieve that level of capitalization. But there are a lot of interested stakeholders. There are a lot of different parties. This is definitely a big issue in terms of coordination. There are existing interests. You mentioned these junior preferred holders. Thankfully, we have no relationship to them. That is something that's really U.S. Treasury's kind of purview as to how they want to handle them. And as you probably know, there is litigation both from the junior preferreds and common shareholders. Some of that is going to need to get resolved in some way or another. The Treasury will need to figure out. I mean, effectively, our shareholder is Treasury, so they're the ones who stand to financially benefit if they monetize Freddie back in some way. They've got to ultimately decide how to resolve those issues. We intend to come to the table with our financial advisors with various proposals how to do it, but it is no understatement. It is a very heavy lift. The largest IPO was Aramco recently at approximately $30 billion. Alibaba before that at something like $25 billion. I'll just put out there, even if we're doing a mix of capital, I said a moment ago, $100 billion is what we need. If we're not the largest IPO, obviously Fannie might be larger than we would be, right. We'll be up there with those two certainly in what we would do.
Yeah, no, so the 250 was what I saw Fannie and Freddie combined in the analyses I've seen of the rules. Now the leverage ratio is more important than the risk-based capital ratio. And there's a top-up provision that I actually, David, don't begin to understand and need to figure it out because I don't know where that number is coming from. Question from Damian Goodman. To what degree is Fannie, and I should say we're coming up to the top of the hour. David, can you stay with us for another 10 minutes?
Absolutely. And my apologies for forcing you to run a little late.
And for our audience, apologies that we're going to run over about 10 minutes, but I think I would like to get a couple of these questions out there. So David, to what degree is Fannie prepared to prevent what occurred immediately after the Great Recession, a foreclosure tsunami, and increase in institutional investors scooping up distressed properties by providing favorable terms to it? And I'm assuming that, and he says Fannie, I'm sure he actually means Freddie, by providing favorable terms to affordable housing operators, community land trusts, to pick up distressed properties to maintain them as naturally occurring affordable housing. So I think the idea is there a way you can come in and allow sort of the affordable housing providers to get a crack at purchasing ahead of sort of the Wall Street opportunistic investor?
So the second part of the question, is there a way we can do that? Absolutely. And we work very closely in our affordable housing areas, both on the multifamily and single family side, in terms of trying to promote sustainable affordable housing, have looked at any number of models, including working with not-for-profits, to mention community land trusts. There is an economic reality that we don't view it as our role to provide kind of grants, if you will, but rather to lean in terms of our financing, in terms of our willing to accept lower economics. I want to be clear. We will accept lower prices, work more closely with not-for-profits to try to preserve something, and certainly we do that on the front end as well. In some ways, really, the bad news answer to the question is where we stand today, we don't actually expect a lot of distressed real estate. We're not seeing a scenario that looks like what we saw in 2008. And in fact, our primary belief is that, and we've really developed the toolkit to deal with distress in such a way that there'll probably be many fewer foreclosures even coming out of what lower stress we have. Meaning much of the stress probably gets resolved through various loan modifications to try to keep a household in its house by modifying mortgage payments. So again, we are very focused on trying to work with a broad range of socially motivated investors in terms of how they can preserve the affordability. The bad news is I don't know that we're going to have that much housing stock to work with.
Well, there is a good news aspect of that. Obviously, yes. is avoiding distress.
Of course.
Better than Not. Let me from Mark Jacobs. Could we get your thoughts around urban versus suburban market? Does he see a difference in defaults, forbearance across those types of markets in the portfolio today?
First of all, hi, Mark. How are you? Good to hear from you. The answer on the residential side, I don't know that we are seeing anything yet. I think it's a great question. I'm going to look into that. On the multifamily side, it's a little more geographically concentrated in terms of around the New York area, probably not surprising, kind of stands out. Other sort of in LA, other urban clusters. And again, I'm going to go back to it's very concentrated in the smaller, lower rent, less institutionally owned real estate. It's really more in Class C than Class B or Class A. Really dramatic skew in that regard. We see really very few operators taking forbearance in terms of institutional Class B, Class A multifamily, away from some student and seniors, where we do see some. So probably not really yet enough even evidence to suggest that skew. But again, it's focused on the denser urban areas broadly and smaller properties.
A question from Vishal Vanjani. Are all new Freddie loans structured with interest reserves? If so, what is the structure? And how long do you foresee the structure being prevalent in newly originated loans?
I will attempt to give an answer and then qualify that anything I say is subject to correction by my friends running the multifamily business these days. I believe we are acquiring a year and a half of debt reserves these days, given the uncertainty going forward. That may differ depending on the deal and the market and the leverage, but we typically don't require that type of reserve in normal times. We simply can't. We would rather be in the market providing the terms that we normally do, but recognizing we could see some softness and reduction in income here in the near term. And so we think the debt reserve is the right way to do that. Obviously, we can release the debt reserve when and if we think it's no longer necessary.
From James Kim, this is a very pandemic-related question. Several weeks ago, there was a push for rent strikes for both the market and affordable multifamily rental communities. If residents successfully set rent strikes, how will Freddie, they keep asking about Fannie and Freddie. I know you're not going to say anything about Fannie, but how might Freddie help borrowers if they're impacted by rent strikes?
It's a good question. I think there's too many unknowns in the question. I probably won't surprise anybody by saying, I think rent strikes are unfortunate. It's not the right vehicle for which I think government support for renters is appropriate. Asking that to come out of the pocket of the owner and holding them responsible for the economic conditions is the wrong avenue for seeking for some type of change. I think we'd have to evaluate on a case-by-case basis. I have to acknowledge, if it's a rent strike because of some deficiency in terms of management of the property, that I view that very differently. If we're talking about it's really a political statement, if it's widespread, my guess is we would look at it in much the context of forbearance. Is if we see the need and we see the hardship, that would be something we'd certainly take into consideration in terms of potentially granting forbearance and put it in that category, and likely to be sympathetic.
I'm going to combine a couple of questions from Terry Hsu and Janice Sims. Do you see underwriting changing permanently in some ways as a result of this? Or are you rethinking altogether how underwriting is done? Or are you just changing ratios for a while and expecting to go back to where they were when things calm down again?
That's an easy answer, and I like the answer I can give on that one. No, we are not thinking about permanent changes. We think where we've been, and as important as ratios is really the discipline that we bring to the underwriting. Our credit losses, and I encourage anybody to go to freddiemac.com and look at them, remarkably low. And they have been low. They were low through the last crisis. Obviously, this has not yet run its course. We think what we're doing now is a temporary adjustment for market uncertainty. All we're really saying is, you say you have $100 in income. By the time we get to the end of the year, it may be $95. We don't know. We don't have a perfect crystal ball, and so we're just underwriting to that relatively short-term uncertainty. We are continue to be bullish about the multifamily sector. We think our prudent underwriting, where we don't just look at ratios, we look at sponsorship, we look at the quality of the management, we look at the property, has served us well. And I go back to something I mentioned about our business model. We don't hold all the risk. We actually hold relatively little. We make all the decisions. But the success we've had in distributing our risk, in selling it to very sophisticated multifamily investors, tells us we are making prudent investments with our loans at prudent ratios. And so again, other than the temporary elevated level of uncertainty we're experiencing, we are not thinking there's any need to change our parameters and change how we run our business.
So I'm going to take the moderator's privilege and ask the last question, and it's going to go to the single family side, and it's sort of a big picture question. Because of loan level price adjustments, there's a pretty clear cutoff between when a borrower wants an FHA loan and when they want a GSE loan. And 680, clearly, if you're below 680 on your FICO, the FHA is just a better loan for you. It's maybe have crept up even to more like 720. What do you see as the role of FHA vis-a-vis the GSEs or vice versa?
I'm going to give you an opinion, but emphasize I am not a policymaker, and that we will execute against the policy that's held up for us. There is certainly a lot of conversation. Where is the appropriate kind of dividing line in terms of where should the GSEs play in the FHA? Recognize these are different models. If we were, and yet our model is still somewhat unresolved, but we are intended to run as if, even if we're not today fully, a private company. FHA is a government subsidy program, a credit subsidy program. And so there is a point at which where there is a need for greater subsidy of the credit, that's more of an FHA program. If we can certainly target that subsidy to the population that most needs it. We do run with a degree of cross-subsidy, as you know well. We very much do look to subsidize first-time home buyers, low and moderate income borrowers, so that we can provide some level of support, but to the extent that we also are looking to achieve basic financial hurdles in terms of our returns in a way that is consistent with a private company, there's a limit to how much we can do that, knowing that we also do experience competition, not a lot, but from the private market, from banks and others. And so there's always a problem of, if we were to try to provide too much cross-subsidy, we can't raise prices effectively on certain borrowers that much, or we'll get cherry-picked there, and actually makes the ability to cross-subsidize less effective, not more so. So it's a delicate balance. You're asking where the line is. Ultimately, it's a somewhat quantitative answer as to which FICO at which price. But the broad strokes are where the true kind of credit subsidy needs to be provided, that it doesn't kind of cross a minimum level of economic return, lower level economic return instead of a minimum level, and it's probably more FHA, and it's the role of government to provide that support and subsidy.
So, well, David, we're up now at 2:11, so I am going to close us up. Thank you very much. By the way, I have to say, did Len do your slides?
No, done by our communications folks.
Okay, they're beautiful. I love the fonts and the colors, and I'm very fussy about slides. So really enjoyed tell your team what a great job they did.
I will certainly pass that along. Thank you.
With their slides. David Brickman, thank you so much for taking time out of your day to be with us this afternoon. Really appreciate it, and hope we can see you again, maybe in person sometime soon.
I look forward to. Thank you, Richard. Thank you, everybody, for having me again, and my apologies, and fight on.